Good afternoon. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at them, we'll take a quick look at the U.S. dollar. We'll see how it's behaving, see if it's affecting oil, gold, or silver, or whether it's even impacting the markets. And then we'll take a quick look at cryptocurrencies as well, and then move on to chart requests. Anyone in here? Welcome. If you guys have a chart you want me to look at, feel free to type it into the chat tab, and I'll be more than happy to take a look at it once we cover the markets. If you like what you see here, or if you're watching this as a recording, you can always follow me on Twitter at StockDarts. You can visit me at YouTube under the same name, StockDarts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas, any kind of analysis I might have in the market, as well as reposts of these Wednesday market streams. Other than that, let's go ahead and get started. First thing I'm going to do is take a look at the S&P 500 through the ETF SPY. As you can see, we've had a pretty good week. We're right back up close to all-time highs. Last week we looked like we were threatening another breakdown. The market still looks like it's sort of stalling out at these levels, and I still think that we're still in the process of transitioning towards a more sideways market environment rather than one that keeps rallying. However, one thing that I always stress is that we want to react to what the market gives us, and that was kind of my opening statement on Monday when I wrote my post on Patreon, was regardless of what we might think the market is doing, or even if the market is doing that in the intermediate or longer term, we still have to kind of respect what the market gives us in the short term and go ahead and kind of base our ideas off of that. And so we were still looking to trade this bounce because that's what the market looked like it was indeed giving us. And so that's what we ended up taking. Now, as you can see, I'm still highly suspicious of this market. We're right up at highs. You can see we stalled out immediately as we came up to them. Now, we are building up for a potential breakout. So we have to keep an eye on that and see what happens next. We are reaching a pretty big inflection point in the overall markets, and I think one that will likely lead to a pretty clear trade environment in the next couple of weeks, depending on how we resolve this. It's pretty clear on the S&P 500. It's not quite the same picture on the other three indices, but I think on the S&P 500 it's pretty clear. And basically, we need to kind of break through this 420, 421 area and push towards the new highs. And I think if we do that, then it's basically status quo. We continue to kind of ride this momentum upwards, and we continue to kind of come up. Now, I suspect that if we get rejected again at these highs, that we're going to just go slice right through the moving averages and break this trend once and for all, and come back and at the very least settle in at the 397 to 400 range. And so we'll see what happens. As you can see, volatility has increased from candle to candle, but we still haven't really gone anywhere. The market is still basically trading in a pretty tight range. We take out our handy dandy rectangle tool, and we take a look at what's going on, and you can see that we're basically just range bound, right? It's the same sort of thing we had last time, back in February, March, and April, where it looked like the market was topping out. It looked like it was beginning to kind of shift towards more neutral, and we got this volatile price action. But in the end, that volatile action was kind of contained to just individual candles, and we didn't see that volatility extend towards the intermediate time frame where we started to see impact on previous months worth of price action. We just chopped back and forth as we kind of fluctuated, and the bulls and the bears kind of fought to figure out who was going to control the price action in the foreseeable future. And obviously the bulls ended up winning. You can see it pretty clearly here when we had a shift and a bounce off support at the 50-day moving average, and we came up and we broke through this browning wedge, and we formed a nice little flag here that eventually resolved to the upside. And you can see once we kind of broke through this 398 area, the candles got really small, showing that there was a consensus between the buyers and sellers, and they all expected price to go up. Now we're starting to see again a bit of growing disagreement between buyers and sellers. The candles are getting bigger. However, we're still chopping back and forth. We're not really getting an extended correction to the downside. I think if we get rejected again, there's a decent chance that we do start to see more volatility to the downside and volatility outside of this range. Now again, this is a theory. Might play out, it might not play out, but it's something to keep in mind and something to watch if you are trading. Those of you that follow me regularly, you'll know that for the last couple of months, I've been pretty hesitant to go all out on my long plays. Not recommending shorts. I don't think we're in a market environment that rewards people for trading short, but I think it's a market environment that is definitely more suited towards sitting out and trading more sporadically and a little bit more cautiously, rather than maybe the market we saw at the end of last year and the beginning of this year, which was one where you just kind of buy, both hands in the cookie jar, taking as much as you can, and let the market kind of sort out your moves for you. I think we're in a different situation now where rather than just try to sit there and grab as much as you can, you want to be really picky and make sure you pick the right flavor, you pick the right cookie that you like, rather than just try to grab any single one you could find. And I don't think we've really changed on that front, and you could see that despite the fact that the market has gone up pretty decently since March, it has spent a good portion of that time trading sideways and chopping back and forth, and actually getting a lot of traders into trouble. So despite the fact that, let's say, we were down at the 380 area in March, and we're all the way up to 420, a lot of traders have still struggled because it's gone back and forth, and they've been kind of stopped out of their trades or closed prematurely or shaken out of their trades. And then we've really had most of that move happen in the span of a couple of weeks, where we went from March 25th to maybe about April 25th or so maybe a month of straight up, and then we've just gone sideways again. And it hasn't been a market conducive to a lot of trading success, and a lot of traders that are having trouble with this. And I think the key during these kinds of environments is to make sure you limit your exposure to them, and you really kind of rein down a little bit and make sure that you are picking just the best setups that you like and the setups that give you the clearest entry and exit criteria, so that you don't make mistakes and you don't let the market kind of fool you into abandoning your trade or into chasing a trade that maybe isn't really ready for a setup to materialize. And so I think that's really my biggest emphasis as far as trading right now, is to just be careful and to make sure that you are being extra picky about what you like, because the market is going back and forth pretty regularly. You can see even over the last couple of weeks we had a pretty big move down, and then we had a nice strong bounce that was quickly rejected, and now we have another nice bounce, and we'll see whether this bounce gets rejected again, and if so, like I said, we will slice right through the 20 and probably through the 50 and come back and retest this 405, 406 area, and probably even break down through there. Although, again, we'll have to wait and see how price reacts once we get to those levels and see whether there's still enough bullish sentiment to go ahead and support this price action again. Anytime you have a strong support level or a clearly defined support or resistance level, the more often it gets tested, the more likely it will break. And so if we come back and retest this 406, there's a good chance it breaks now. Conversely, we're coming up for the second test of this ceiling. And if we can break through that, then again, that's very strong, very bullish, and it means that we will continue this upward trajectory, and maybe we get another month of nice price action like we did back from the end of March to the middle of April. And so that's something to keep in mind. And like I said, we are reaching a kind of a critical inflection point where we're going to have to decide, are we ready to break out and get another one of these little moves up, or are we going to come right back down and get rejected off of the highs, and then have to really spend time figuring out whether we are going to stay in this rectangle here or come back down and revisit the previous price range from March and April. And so, we're at a spot where it's not easy to decide what you want to do, which is why I'm saying it's better to be picky right now and not get overly aggressive. Now, like I said before, if you take a look at the longer term chart, everything is still fantastic. There's a lot of room for us to correct and still be in a very strong bull market, which is why I say it's not a good idea to short. Hey, Fat Boys, good to see you in here. I haven't seen you in a long time. I hope everything's going well with you, and I hope you've been able to survive these last couple of months of trading. I know a lot of people did really well in November and December and January, and they're starting to struggle. So hopefully you haven't had to deal with that. You've been busy working, which is good to hear. But good to see you in here. And like I said, if you have anything you want me to look at or you have any questions, type away. It's always nice to have interaction from the chat. Whoever else is in here as well, feel free to talk to me. It makes it much easier for me to fill an hour of airtime when I have something to talk to rather than just staring at my screen. So back to the S&P 500. Like I said, you can see in the long term we're in a pretty strong bull market, and the long term picture is still pretty good, and the intermediate term picture is actually still pretty good. It's the short term picture that we're worried about right now, and I think the short term could bleed into the intermediate, depending on what happens. And so what I mean by that is if we kind of get rejected here again at 420, and we start to break through these moving averages, I think we could end up having a situation where we just kind of start trading sideways, much like I mentioned last week, in which we'll see in a second has already occurred on the NASDAQ. And if we're going to follow the NASDAQ, and if the NASDAQ is truly still leading the way forward, then we're going to see something similar happen to the S&P 500 in the near future, whether it's this week or whether it's in the next month or the next couple months. But sooner or later we will break this trend, and we will start trading sideways at the very least, and possibly even further down, as we begin to establish a sideways trading range that's a little bit more sustainable than maybe the upward trajectory that we have right now. Sure, we'll take a look at LPG once I finish looking at the markets. So that's kind of my thought process, not just on the S&P 500, but the markets overall. We'll see how the NASDAQ, the Dow, and IWM affect what we're seeing with the overall markets. But the S&P 500, like I said, I think the key level right now, the most important level is going to be these new highs here, right around 422 or so, just above 420. And that's the critical level that we need to break through. And I think if we lose that level, the 20 and even this level here around 411 are going to be short-lived, and I think it's the 50-day that's going to be important, and I think we probably even lose the 50 and lose this trend line in the process and come right back down and test 397. I think 397 is going to be a critical support zone as far as establishing the buyers coming in and trying to support the price action, more so than the 50. However, until we lose the 50, we have to assume that's going to be an area that will be defended. So we'll keep an eye on that and see what happens if we do break down. And like I said, if we do break out, well, that's good news, and that likely means that we should get a good week or two of trading where we can maybe become a little bit more aggressive again. But we'll see whether that happens or not. Again, I still have a lot of suspicion that this is going to be a wall that's going to be difficult to truly break through. So we'll see what happens over the next couple of days and whether we do see another rejection or not. Now, if we look at the NASDAQ, this is what I was saying before. The NASDAQ has already started trading sideways, and it's done so pretty convincingly. It had a very strong rally into the holidays, and then it kind of broke down. Now, again, I think that while this is part of the NASDAQ leading us into a sideways range, it was also a function of capital rotation, which we've gone over ad nauseum over the last several months. Money going away from stay-at-home stocks into recovery stocks that are benefiting from the population getting more and more vaccinated every single week and going out and traveling and just generally going back outdoors. And so that has been a function, or the NASDAQ's price action has been a function of that. As part of the reason that the NASDAQ has stalled out, even though the markets in general have actually climbed a bit. Now, we're seeing a little bit of a response back upwards from the NASDAQ over the last week, and I'm not sure if this is still just a short-term fluctuation or if it's money rotating back into tech. It's probably a little bit of both. And I think that it's still important to see what the NASDAQ does. I think, the FANG stocks are the leaders now for a reason. That's really just the way our economy works. And tech is the most important sector at this point. And so watching what the NASDAQ does is still critical. As you can see, it's pretty well off the highs. It did get back above a pretty important area, which was this 330 area. This was a very important area that we were watching last week. And it was critical for the bulls to get us back above that in order to stave off a further correction where we got stuck in this range here. As you can see, there's a little bit less margin for error with the NASDAQ compared to the S&P 500 when you compare where we are compared to what we were doing in March, the last time we were really volatile in the markets. And as you can see, that we actually kind of came back in and actually were right back into that range. We did a nice little double bottom here around 317, and we're able to break right back above not only 325, but get back above this other intermediate level right around 330 or so, and more importantly, get back above the 20 to 50. Now you can see the 20 to 50 day moving average are sideways, indicative of a range bound market and a market that's going sideways. This is not the picture you normally see when you're expecting a rally to start continuing or begin. Uh, the moving averages aren't aligned in the proper formation for a new rally. Now, it could happen. It could be that we just swoop right back up like we did this last time and make our way back upwards. But more likely than not, what happens is we're going to come up and get rejected at the ceiling and come right back down and continue to trade sideways. It usually takes a good 2 or 3 attempts back and forth before you're really ready to move forward. Like I said, if we go ahead and take a look at a weekly chart, we scale back even further, you'll see the last time we were in a broad range, how it played out, right? You had the move into it, and then you kind of went sideways, you went up, you came down, had a strong correction, came up, they kind of corrected, and then eventually were able to break through it. It doesn't seem like that much when you just look at it from one impulse to the other, but if you look at it, it was basically from 2018 to 2020, so it was almost full years of going sideways before it was able to finally get enough new momentum to start pushing upwards towards a new rally, which was, of course, interrupted temporarily by the coronavirus pandemic really spreading early last year. However, we were able to shrug that off and continue that rally. And as you can see, we're reaching a point where that rally is probably pretty close to ending, and we're probably at a spot where we need to start developing another one of these ranges. And these ranges could take months or they could take years to fully develop. And so that's kind of where we are. At least that's my interpretation of the price action. And I think it's pretty clear in the NASDAQ, even though it's not so clear in the S&P 500 yet. So with that being said, our expectations should be that we struggle at the ceiling and that we find a lot of sellers and we push back down. But when we hit the floors, that we should be able to find buyers to push the market action right back up. Now, I don't think we have a really cleanly defined floor for the NASDAQ. And as a matter of fact, to a certain extent, you could almost say that we have a new upwards trajectory developing. I think it's a little early to really trust this, considering that really it was this before. And you can see that if we look at it from that perspective, we already broke it, and now we're kind of struggling to reclaim that. So I wouldn't exactly trust either of these trend lines, but it is something that we will watch and see whether they play out and whether either one of those two scenarios gains a little bit more significance as we push forward. But you can see we already had one upwards trajectory that broke, and now we have a second one that might break as well. So we'll see what happens, but the key here is, can the NASDAQ stay above the 20 and the 50? I think more so than trying to get to new highs like the SPY. I think with the NASDAQ, it's more a matter of just maintaining this positive action and not falling right back into this previous range. And so a critical level on the Qs is going to be is going to be this 324, which is of course the ceiling from the previous March range. And more importantly, this 330, which is going to be this confluence between this short-term level of support and resistance as well as the 20 to 50-day moving average. And if those hold, then I think it bodes well for the market, and it would bode well for the S&P 500 to try to break out. Now, if the S&P 500 gets rejected, there's a good chance the NASDAQ will follow suit and head south as well and probably break right through these moving averages. And then the key is going to be somewhere between 323 and this double bottom around 316, 317 to see if buyers can step up and support it, or whether we head back down and test the 200-day moving average, which has not been tested in a long, long time. All right, so those are the NASDAQ levels. We'll see again a pretty different picture with the Dow Jones. The Dow Jones, much like the S&P 500, is still in a pretty good uptrend. And while it has started to trade sideways recently, it has not done so with enough impact to break this upwards trajectory. You can see we're still holding above not only the 50, we're actually holding above the 20-day moving average. We're pretty close to all-time highs. We are still struggling with a pretty good short-term resistance level, which is right here, which is the bottom of this little gap that was formed when we kind of accelerated down a couple weeks ago. And much like the S&P 500, we need to see a breakthrough, whether this gap gets filled and we break through it, or whether this gap gets filled and we get rejected. But we need to see some kind of price action to try to break through that. And I think, again, just like the S&P 500, we are at a critical inflection point where either we get rejected here and really start to correct, or we break right through that and start printing new all-time highs. So a lot of what I said for the S&P 500 is going to stand for the Dow Jones. It's the same idea. There's a little bit more room to go before we really get to decide whether it's rejected or not. But if we do break 345, we need to get through this gap and continue upwards. If we just get to this gap and get rejected and head right back down below 345, well, I would consider that a price rejection. I would expect us to break the 20 moving average at the very least, and probably come down and test the 50 and test this 337 area, and possibly even break that. Because like I said, I think getting rejected at highs yet again will probably be, it'll probably be a little bit of a kind of a gut punch to the bulls, and they might be a little bit more hesitant to want to buy until we get to lower levels or levels that they could trust a little bit more. So we need to watch what happens here and how we play out as we come up and retest this area. Now to the downside, like I said, the 20, I think we're too close to it to count that as any kind of real support level. The key is going to be the 50-day moving average and this 337, and beyond that, this trend line here, which would probably likely be somewhere around the 334 area, would be the next area of support. Now again, we got a long way to go before we test the 200-day, so we're still in a pretty decent trend here, and it's going to be a matter of whether the Dow Jones continues to lead or whether we see rotation back into the NASDAQ at some point and the Dow Jones takes a breather. But generally speaking, the Dow, like the S&P 500, still has a pretty good rally going, and it's going to be interesting to see how it plays out. And if we do get a correction, what's going to happen next? More likely than not, if we do end up getting a stronger correction, it'll follow suit like the NASDAQ and maybe break that channel and spend a little bit of time floating in space before it tries to rally again. So again, I don't think that anything I'm saying here, as far as expecting a short-term correction, I don't think it has an impact on my longer-term outlook on the markets. It's just a matter of what I expect from the market in the near term, and how I can, how it can move forward, and whether we do end up shifting towards a more sideways price action in the near future. All right. Here's IWM. Here's the Russell 2000, the small caps, and just like the NASDAQ, we've already kind of broken our trend. You can see that we're trading sideways. We've been trading sideways for a while. And give me 1 second. All right, I'm sorry. So, in stark contrast to what we just saw in the Dow Jones, you'll notice the small caps are actually below their moving averages. Their moving averages are actually starting to point down. And so, in this particular case, we've already lost our upwards move, and we're just trading sideways, and we're not anywhere near pushing towards highs. And so, just like the NASDAQ, where there's a different set of goals that need to be done or need to be filled with the small caps compared to maybe what the S&P 500 and the Dow Jones are trying to do. So, just like the NASDAQ, I think IWM and this, Russell 2000, they're just trying to stay sideways. And just like the NASDAQ, you can see we had this upward trajectory that was broken, and now we can maybe try a new upward trajectory and see whether that can hold. But I'm going to leave this for now. And it basically mirrors what we saw in with the NASDAQ, only a little bit cleaner. And so this is what we're doing here. Whoops. And this right here that's not really a bullish pattern. Typically, when you lose an ascending trend line like this, you come up and you try to get back above it. If you get rejected, you come back down and you form this kind of wedge. If this breaks down again, well, we're going to head right back down to 208. And then we're going to have a real test on our hands because this is going to be a critical floor that needs to hold if we want to continue to kind of at least have the hopes of the markets rallying further. Now, IWM has been the least significant of the four market indices over the last few years. It has been weaker for the most part, relatively speaking, to its peers. So it's not the end of the world if the small caps lose this. I think if anything, it just goes to show that traders are getting more cautious than maybe what they felt like in November, December. And like I said, this is actually a good gauge for what we should be doing, right? If this is a good picture of traders starting to get a little bit more cautious and starting to avoid more volatile assets and riskier trades, this is what we should be doing. We should be avoiding the same risky assets that the overall market is doing. And it doesn't mean we avoid trading small caps altogether, but we understand that this is a point where we should be mitigating risk, not assuming more of it. And so, until we see this pattern shift, and we see the small caps start to lead the way upwards, we see the tech names lead the way upwards, we know that we need to be more cautious and more picky about the trades we take and not get too aggressive about trying to take advantage of a market environment that has kind of passed us already. And so, we're at like I said, a pretty good inflection point, not just in the short term, looking at what the S&P 500 and the Dow Jones are doing, but also in the intermediate term, when you consider what the small caps and the tech names are doing versus what the S&P 500 and the Dow are doing. We have two indices that are already trading sideways and are kind of stuck. They're not really ready to challenge new highs. If anything, they're ready to kind of come down and test lower levels. Well, we have two indices which are trying to push to new highs. It's a little bit of a tug of war, and until we see the four indices moving together, it's going to be a lot harder for us to find trades that are easy to take with clean signals and clean moves. And it's going to be a lot more choppy price action because, as you can see, the market is in a little bit of discord right now, and is kind of going in different directions. It's not really in tune with itself, and so you're getting a lot of choppy moves back and forth because you have different areas of the market trying to do different things. That's going to make it, like I said, difficult for us to find clean trades. I mentioned an idea last week. It's something that I've always kind of tried to hammer home to anybody that I mentor trading, which is, your number one goal as a trader is to protect your capital. It's to, measure risk. It's not to look or seek out profit. But there's another important kind of capital you want to protect besides your money, and that's your mental capital and your psyche. It's really easy to do a lot of damage to your mental frame of mind when you try to force trades in a market that's not conducive to them, and you end up losing a lot of trades, and you end up starting to doubt yourself. You start to doubt your trading process. You start to wonder what you're doing wrong, and you start to make changes that maybe aren't necessary to your trading style. When in reality, what's happening is a reflection of what the markets are doing, not necessarily what you're doing. No matter how good of a trader you are, you're not going to do as well during this kind of time frame compared to what maybe November, December, January. Even for myself, that I actually thrive on range-bound price action. This is kind of my favorite type of environment, is when you're going back and forth and you're just selling premium or taking advantage of short moves. It's actually one of my strengths as a trader. But even then, it's much easier to trade in November, December, January, where pretty much any setup that's looking for a long ends up working in your favor. At this point, this is more of a probabilities game where you have to understand what works and what doesn't, and understand that you will lose a certain amount of trades, and play it along those lines. So, you want to protect yourself during these times and make sure you're taking the right styles of trade, and you are making sure not to put yourself in a position where you start to really get into a slump because of the fact that you're trying to make trades that aren't going to work because of what the market is doing, not necessarily because of what you're doing. All right, so that's my thoughts on the markets. Hopefully we get a little bit of a clearer picture in the next week or two, depending on how the S&P 500 and the Dow Jones navigate the ceilings that they're kind of dealing with at the moment. And then we'll get a better idea whether it's straight, well, even if it's just a sell-off, at least that's easier to predict than what we're seeing right now. Let's take a quick look at the U.S. dollar. We'll look at oil, gold, silver as well, and then we'll move on to the chart requests and see what happens. So the U.S. dollar is looking to stabilize here. And we've got an interesting picture with the currencies that I like to look at. And that is that you can see the UUP index is it's setting up for a nice bounce here. It's trying to stabilize at the floor, but we have a different picture when we look at the euro US dollar cross. As far as the euro is concerned, it has already, and remember this is going to be inverse, so that floor that the US dollar is stabilizing in, it lost it versus the euro. The euro actually broke through a pretty critical resistance level. Uh, it's not forming the most. It's not really forming the most bullish of patterns. You usually don't want an ascending channel on a flag. You want it kind of descending or sideways. I think part of that is because today's actually a pretty big rejection. You can look at it along these lines. It actually was. We had a nice little bull flag. We broke out. Now we failed, and so we're heading right back down. Which looks again like the U.S. dollar is starting to gain a little bit of momentum here. For those that followed last week, if you trade Forex, I mentioned the possibility of a bounce coming on the U.S. Canadian. It actually tried and failed, but it is trying again. And again, I think that this looks like a pretty good tradable bottom. But a lot of it is in this particular case, it's going to depend on what oil does, which we'll get into a second. And then finally, we have the U.S. yen. And this is also another chart that's looking a little bit bullish, where we can see that we had a correction, and we're in the process of trying to break through that correction right now. So I would say we've got a few charts here that are pointing towards a possible U.S. dollar bottom, with the one exception maybe the euro, but even that one we're seeing the U.S. dollar start to gain strength versus it. So it looks like maybe the U.S. dollar wants to start to break out a little bit. And that might put pressure on the markets. And that might put pressure on gold and silver, which have actually done pretty well recently. You can see gold and silver have actually run up pretty strongly. Much stronger than I anticipated, as you can see. A lot of green candles in a row. And I think at this point, if you're a bull on gold and silver, I think you need to wait for a pullback. Like I said, I haven't been very interested in trading gold and silver for a while. I didn't like the fact that we were mired in a pretty big correction when they should have been rallying compared to what the dollar was doing. And I find it kind of odd that as the dollar starts to perk up, we're seeing gold and silver perk up as well, but it is what it is. However, we're seeing a nice strong move out of this, and I think at this point, the good sign is that gold has broken that long-term downtrend, and so on the next pullback, it should be a little bit more easy to trust it as a long play compared to what we've seen before. And silver's kind of doing something similar. You can see silver's just been chugging along in this little channel here. I think long-term, it's a much sloppier picture than what we've seen with GLD. You can see it's just a kind of this broad kind of consolidation. And there's still a lot of work to do to kind of break out of this range, but it did definitively find a bottom, and it is making its way upwards. In the short term, I don't have any interest really in either one of them. I think SLV does look okay compared to GLD, but I think part of that is because it's actually lagged recently. So it might not really be ready to break out, but a lot of this will depend on what the U.S. dollar does. I think if the U.S. dollar rallies, we get a big bounce. These will come back, and then we'll have to wait for them to settle in. If the U.S. dollar falters and falls apart, then I think GLD might continue running up, and then silver might try to play catch up. And then finally we have oil. And as you can see, oil's kind of stuck here. It actually broke this ascent, which was something we were watching with the U.S. Canadian cross, but it rebounded pretty quickly. And it's right back at these highs. And I think that we're still at a pretty critical inflection point on this one as well, and see whether it can hold at these levels. You can see that we are developing a pretty clear ceiling here. And it's going to be important to see whether we get rejected again and head right back south, or whether we break out and start to continue this rally. And I think that will be, the U.S. Canadian trades inverse to this. So this is really, if you want to trade that particular currency cross, you want to look at this. Now, I do want to look at the cryptocurrencies before I get to chart requests. However, Fat Boys, you want to look at copper. I forget what copper's future contract is. Is it HG? Or if you just want to look at Freeport McMoran, I'm not sure what particular chart in copper you want to look at. But let's go ahead and just take a look at this right here. Typically with copper, I just look at Freeport McMoran, but as you can see, it's been in a pretty nice run. Very different from precious metals. And I think this, again, I imagine this is similar to what we're seeing with oil, which is, again, the idea of recovery and industrial metals picking up and doing better. I know I had some steel names that were doing well on my watch list this week when I was looking for potential trade ideas. And so I imagine that this is sort of the same thing where you're starting to see industrial names pick up a little bit of momentum. And you can see, obviously, copper has done well. It's been a nice turn since the middle of last year, and it's really started to take off recently. And like I said, I think that this is probably a good reflection, of what we're expecting from these metals in the near future. All right, so before I get to LPG, let's take a quick look at Bitcoin and US and Bitcoin and Ethereum, because they had big moves as well. You can see we had a huge drop. And we have the possibility of a bottom forming on Bitcoin. This could have been a pretty good buying opportunity for anyone that really has been waiting to get in on Bitcoin. Now, there's still the chance that we falter, we fail, and we have to correct even further. And if that's the case, then there might be even better buying opportunities somewhere else. However, while we're seeing Bitcoin kind of sluggish, we are seeing other currencies pick up more steam now. Again, Ethereum, same sort of pattern, only not at the bottom of its range, but the same idea. We saw a pretty big recovery earlier this week, and while we're struggling a bit today, we are seeing a little bit of recovery on these, and so that could have been a pretty good buying opportunity for anyone that was waiting for a flush. However, when you see these kind of big moves down, it usually takes a little bit of time to really kind of hammer out and test that and make sure that we're done dropping. So there could be more opportunities in either one of these if we see another sell-off coming in the near future. Or it could be that this is the only thing, this was the discount that we needed, and we kind of make our way back up to highs. I think we're, again, just like the markets, we're at a little bit of an inflection point here with the cryptocurrencies, and we'll see what happens in the near future with them. But it looks like they bottomed out after what was a pretty significant correction over the last couple of weeks. All right, so that's what I have as far as what I'm looking at. Let's take a look. Fat Boys, you wanted to look at LPG. I don't know what this is. Oh, it's transportation. Okay, shipping. Well, I haven't looked at shippers in a while. I mean, the chart looks pretty good. At least as far as where it stands. We do have a bit of an issue here, which is that it fell back below that trend line that I just pointed out. All right, so here's a pretty good look at what it's doing, right? And I could probably draw an ascending trend line here. Let's take a look at the weekly picture to get a better idea of, oh, so there we go. That's what happened. What is this, 16? So, okay, so I think the chart looks fine, but there is the possibility of not that much potential upstairs, because as you can see, there's going to be some walls that are waiting pretty close by. Let's see if we go further back. We have to go pretty far back. All right, so yeah, so these are important levels. All right, so let's go back to the daily now. So we understand now what happened here and why it was rejected. It's done a good job here of building out a range. And this is very similar to what the NASDAQ was doing, where it kind of had a nice upward trajectory, and then it shifted towards sideways. but it's trying to move past that range, right? And you can see we had a nice breakout. It was rejected right where it was supposed to be rejected. And the only problem I have with this is typically on a breakout, when you consolidate, you want it to be small candles, not this kind of wild and volatile. Uh, so we need it to quiet down, and then we need to see another breakout. I don't know that I like this that much right now, um, because I don't see a lot of potential as far as the ceiling is concerned. It looks to me like you have a dollar of upside here, maybe, and then maybe $2 of upside. Now that's pretty good if you consider the downside, especially if we keep it kind of close. Um, so if we got a green candle tomorrow and we were able to break back above 1460, I could see a case where you have your stop here around today's lows, uh, and that's maybe a 50-cent stop, right? 50, 60 cents. And you're looking at about $1 to $2 of profit. So those are pretty decent odds in the kind of environment we're in. The problem is that even if we get a green candle today or tomorrow, we're still stuck in this little this kind of triangle, right? So it could be that we get stuck and we chop back and forth and then break out. And then if we do break out, well, we still have this ceiling up here, and then we have this ceiling above it. So I think from a financial perspective, this one is fine. Like as far as risk reward, I think from a mental perspective, this one would be difficult to navigate because you're going to have a lot of incoming decisions to make when it hits this trend line, when it hits this trend line, and if it hits the next trend line, or if it doesn't survive this trend line or this trend line, right? So I think there's so much noise here that it wouldn't be an easy trade. But that being said, I don't think it's a bad trading idea that's developing. We don't have a clear entry signal right now, and that's going to keep me from saying go ahead and trade this right now. But if we do get an entry signal in the next few days, I think even better if you get lucky enough where this kind of chops back and forth, and then your entry signal is here, then I think it's much easier to trade because then you don't have to worry about it breaking this trend line because it has already done so. But if we're looking at an entry tomorrow, just based off of it getting back above 1460, then it will be a little bit of a difficult trade uh, to work off of because you're going to have a lot of decisions to make in the near future as it deals with the range that it's kind of stuck in. So, I don't think it's not a bad trade. And I think from a risk reward perspective, just for money, I think it works out. It could work out well, depending on what it does. Now that being said, I would not buy today. There's volatility. Of course, earnings had a part to do with this, right? But volatility increased as it was consolidating. That's usually not a good sign of a good continuation move up. So we still needed to kind of clean up and give you a better entry signal. And at this moment, you do not have an entry signal, for sure. Now, you could get one as early as tomorrow, although it will be less reliable than one that you would get in a few days if it were to break this trend line. So, a lot depends on how it plays out over the next few days, and then we'll see. Okay? All right. So, does anyone else have a chart they want me to look at? As far as what I was looking at this week, we were looking at Tesla, and as you can see, we got a nice little bounce here off of this floor. The last 3 days, it kind of got back above the 200-day moving average. It's still kind of stuck in neutral. But I suspect if the markets are going to break out, then tech kind of has to follow suit. So we've got a nice little positive move today, but we still haven't really reached what I was expecting, which is the 50-day. We did expect a little bit of trouble with the 20, but we were looking at Tesla and CHWY because these are stocks that I actually kind of like. longer term, and so I thought that they make sense as swing trades. You can see CHWY got pretty close to our profit target, at least in the short term. We do expect it to get maybe up to 78, but we got a nice bounce and made our way through the 20-day moving average. It was actually looking a little better before I started this webinar. And then the last one we were looking at is at restaurants, and we were looking at Cheesecake Factory. And this was still kind of stuck. We finally got the breakout today, so this could still be developing for you guys in here. But it's got a lot, just like the last, just like the LPG trade that Fat Boys just shared. This one has a little bit of decisions to be made because the moving averages are right above it. But I think that it's a good floor here, and it looks like we're finally kind of settling in and maybe getting ready to try to challenge the top of this range. So that's kind of what I'm looking at. You can see the one clear thing that I'm looking at is very tight risk to reward, or very tight risk versus what the potential reward is on these trades. I'm trading pretty close to a floor because, again, I think the market is transitioning towards range-bound behavior. So I'm looking at trading ranges, which means I'm not trying to trade the top of the range. I'm trading the bottom of the range, and usually after a consolidation period. All right. So that covers it for today. Glad to see you in here, Fat Boys. Hopefully I can see you more often. Hopefully work gives you a little bit more free time. Those of you that are in here that did not say anything, glad to have you in here as well. If you ever have any questions and you'd rather ask in private, just message me on Twitter, and I can send you a chart that way. And other than that, feel free to visit me at patreon.com/StockDarts, where again you can see more analysis on how I view these trades and what I'm trying to tailor my strategies towards whatever environment we're in. Other than that, have a good rest of today, and we will meet again next Wednesday.